In this mini lecture, we're going to look at Chapter 8, which looks at implementing strategies from a finance and accounting perspective. You may pause your screen here to read about the learning objectives in this chapter. I want to start by talking about some of the accounting terms that you'll read about in this book, or in this chapter. EPS is earnings per share. This is calculated by taking your net income and dividing it by the number of shares outstanding. EBIT is earnings before interest and taxes. Sometimes it's called your operating income. Shares outstanding is similar to your shares issued, but shares issued also includes treasury stock. Shares authorized are the number of shares of stock a firm has approval to issue in totality. EBT is earnings before tax, and EIT is earnings after tax. All right, so some of the finance and accounting issues that come up when you're looking at strategic implementation is determining your capital structure, or really how much capital or money you need to implement your strategies. And this is usually done by performing an EPS EBIT analysis. You also want to develop projected financial statements to see what kind of impact your strategies or recommendations will have on your firm. Finance and accounting professionals also need to be able to understand how to perform a corporate valuation. This is used in the event that your company or your firm is being acquired or you're selling it. They have to be able to analyze financial ratios. And they also must be able to manage the initial public offering or an IPO, manage cash levels and corporate bonds. So capital structure really looks at the proportion of debt to equity on a balance sheet. And performing the EPS EBIT analysis is a way that is commonly used to determine the appropriate capital structure. And so here we're looking at whether we should use debt, stock, or a combination of the two to raise capital to implement our strategies. And so we're looking at an examination of the impact that debt versus stock or a combination of the two has on your earnings per share in different situations. So in unfavorable situations to very favorable situations. Here's an example of Procter & Gamble's inputs that are needed to perform an analysis. So when they say 5,000 million, that's actually 5 billion. So they need $5 billion. Their earnings before interest and tax is usually 10 to 18 billion. The interest rate that they pay is 5%. Tax rate is 23%. The stock price is $94.17, and they have 2.55 billion shares outstanding. So let's take a look at it. So here they put it, there's a pessimistic, a realistic, and an optimistic scenario. And so here's what it would look like if you had used finance it with common stock or just issuing stock, debt, so taking out a loan from a bank, or a combination. And here it would be a 60-40 combination. So we can see, so what we're looking for here is the highest earnings per share. And so you can see that in the situation where it's a pessimistic outlook, using common stock is more favorable. So if we think the economy is not going to be doing very well, or we're going to have some real threats to our business, we might want to use common stock because of this pessimistic view. If, though, it were either realistic or optimistic in this case, so for both, you can see that debt financing has just a slightly higher earnings per share than both common stock or a combination. And so if you had a realistic or an optimistic outlook, the economy was doing pretty well, and you expected it to remain that way, then you would want to finance your strategies with debt, so taking out a loan. Right? And so you can also graph it. So this shows your common stock function financing, debt financing, and then a combination of the two. All right. So we also can look at projected financial statements, which allows an organization to examine how the expected results of your various actions, approaches, strategies, what kind of impact it will have on the organization. All right, and so there is a way to do this. So you want to prepare a projected income statement before your balance sheet. Use a percentage of sales method to project cost of goods sold, or sometimes called COGS. You want to calculate your projected net income. Subtract the net income from any dividends that are paid. So dividends are what are paid to stockholders. Then create your projected balance sheet um, and use the cash account as the plug-in figure and then have commentary. So I have an example that was also in your book. I didn't do the commentary though. All right, so this is P&G's actual income statements for 2016 and 17. So you can see they have their revenues, cost of goods, earnings before interest and tax. Here's their interest expense, here's their tax expense, and then their net income. So their net income was actually up 45%, which is pretty impressive. Here's their balance sheet. As you may remember from your other classes, the balance sheet, the assets has to equal liabilities plus equity. And so you can see the numbers balance out there. Right, and here's their projected. So this was the actual, right? So now here's their projected. So they're saying, here's what we project based on our strategies for our net income in millions in 2018, 2019, and 2020. And so you can see they're expecting to have a little bit of growth in their net income, so about 9.2 billion, 9.5 billion, 9.9 billion. Okay, you can also look at their projected balance sheet, right? You can see that's also going up. And then you can look at their retained earnings. So they have their net incomes, and then in some situations, firms pay dividends. So here they're projecting that they'll pay dividends. So they'll have their retained earnings plus their prior year's balance sheet retained earnings, giving them their current year balance sheet retained earnings. Okay. So one of the last things we want to talk about also is corporate valuation. So this is not an exact science, and it's kind of open to interpretation, but there's some different ways that it can be done. So the valuation of a firm's worth is based on financial facts, but also some less objective or more subjective, or more objective, excuse me, more objective variables. No, excuse me, more subjective variables. Just having a moment. All right, so just some common sense and judgments. All right, so there's different valuation methods. So there's the net worth method, which takes your total shareholders' equity minus your goodwill and intangibles. Your net income method, so you take your net income by 5, times it by 5. The price earnings ratio method, so you take your stock price divided by your earnings per share and times it by your net income. And then the outstanding shares method is the number of shares outstanding times your stock price. And so these are just 4 methods, but there's a lot of different methods for evaluating or for putting a value on a company. All right, and so here are some examples from Procter & Gamble again. So here's some of the data that you would use. So the 4 valuation methods. One of them says it would actually be worth negative. The net income says it's worth about 76. Let's assume these are 76 billion. The share, if we look at the price earnings ratio, it's 240. Same with the outstanding shares method. So if we took an average of all of them, it'd be worth about 100 and almost 136 billion dollars. We can also look at financial ratios. And financial ratios look at we look at how your ratios have changed over time, how they compare to industry norms, and how they compare to our competitors. And so here's some of the more commonly used ratios. So inventory turnover, receivables turnover, payables turnover. These are just some of them, some commonly used ratios. And so they basically take 2 numbers. So here they take the cost of goods sold divided by your average inventory to get a number. And so again, ratios are really used to compare to how you've done in the past, compare to industry norms, and compare to your competitors. So the last piece we're going to talk about is IPOs and corporate bonds. So an IPO is initial public offering. You might hear it say going public. It just means we're selling off a percentage of our company to raise capital. And so basically we're selling stock. in order to raise money for the business. You can also issue corporate bonds. This is somewhat similar to going to a bank and borrowing money, except that with bonds, the company obtains the funds from the investors rather than the banks. So, right, with that, I hope that gives you a good overview of the chapter.